So good afternoon, everyone. Thank you for joining us on our webinar today. My name is Jay Snodgrass. I work within the MineralSoft group at Enverus. For those of you who aren't familiar, MineralSoft is Enverus's mineral management technology platform, utilized by many of the leading mineral investors to more efficiently manage their mineral investments and protect themselves against risks. I'll also serve as today's moderator for our webinar. The topic that we are covering today is preparing for the unexpected, protecting your mineral investments when producers file bankruptcy. At last check, we had about 500 people register, so it's obviously a topic that has resonated with a lot of people and probably not surprising given what's happened in the last 30 days or so. I want to quickly start by outlining a couple of ground rules. The first is that the webinar is being recorded. A copy of the recording will be sent to everyone early next week. Also note that all participants will be muted through the entire presentation. However, all participants are able to submit questions through the question portal, and we'll do our best to answer all those during the Q&A period at the end of the presentation. Little side note here, all the participants on the panel today on this live call are in jurisdictions with shelter-in-place rules, so we're all calling in from home, as I'm sure many of you are as well, so please excuse us in advance if you hear any children, pets, spouses in the background, or if any of the participants have internet connectivity challenges. The agenda for today's call, we blocked off an hour, 60 minutes, is as follows. We'll start with a market update from Sarp Ozgan, who is a director of energy analytics at Enverus. Sarp will give the audience some insights on market forces at play that are causing the E&P companies to potentially face the risk of bankruptcy. Then we'll hand it over to Phil Dunning, who is from Enverus's strategy group, and Philip is going to give a short overview of some of the products and services that Enverus has to help our clients navigate through these challenging and complicated times. Then we're going to loop in our two guests from Graves, Doherty, Heron & Moody, a law firm here in Austin. We have Nicholas Miller, who is in the firm's oil and gas practice, and Brian Cummings, who's in the firm's bankruptcy practice. At the end, we'll leave probably about 15 minutes or so for Q&A. As a reminder, everyone's in mute throughout the entire session, but you are able, and we really encourage you to submit written questions through the portal, which we'll make sure we address in the Q&A session at the end of the presentation. So with that, I will hand it over to Sarp to kick us off with a market update.
Thanks, Jay. So we'll go ahead and start with some introductions and key takeaways around the slides that I'll be presenting. Of course, at this particular moment in time, as we speak, OPEC Plus is meeting to figure out what they're going to do with regards to the cuts, and we'll discuss what that might mean for the conclusions that we see here and the U.S. market. That is ongoing, and we've been watching that closely all day. So we'll talk a little bit about that. But all of these slides were, of course, prepared prior to this, so we'll talk about the impacts that it might have on any of the conclusions that we see here. The crude oil markets are definitely under unprecedented pressure. The fact that COVID-19 has taken more than 14 up to 20 million barrels a day of estimated petroleum product demand off the market in the last couple of months, and will continue to do so for another couple more, has really been the problem here. But of course, the talks between the OPEC Plus members back in March that led to them scrapping their production cut deal and starting a market share war also added some fuel to the fire as prices crashed down to down to the 20s, and global stockpiles started to fill up. And that has really meant that we're at a point right now where just because of the lack of operational capacity remaining in storage, that we could see operations grinding to a halt, mostly going into a base decline, and some shut-ins actually occurring across the United States for the sake of being able to navigate this unprecedented decline in production and decline in demand and increase in production. The oversupplied oil market will mean that the crude prices stay low even with a with an OPEC cut. We saw that OPEC was considering cuts of up to 15 million barrels a day. Right now, the numbers that we're hearing are between 10 and 12 million barrels a day to be contributed by the OPEC Plus members, with additional cuts expected to be asked of the G20 countries in tomorrow's meeting. But even those levels of cuts do not bring us back to equilibrium in today's market. And that means that the oil prices will continue to stay low, maybe even head lower, as we've seen the prices claw back at the almost 12% gains that we had earlier in the day to now turning negative with the cuts not appeasing analysts due to just the demand drought that we're in. The bright point in this whole piece of the puzzle, though, is that an oversupplied oil market will mean that crude prices stay low, and that means that natural gas production will decline along with crude oil production, crude oil directed drilling. That means that natural gas production will continue to fall throughout the injection season that we're heading into. But once, even if we fill up inventories for natural gas, and we see a further depressed price point throughout the summer injection season, once winter rolls around and the demand picks up, as it does every winter, we will draw down those inventories and likely see that due to the production declines, we'll have to have a huge jump in natural gas prices above $3.50, above $4, most likely, to actually incentivize dry gas directed drilling. So there is some positive notes there for natural gas production in this time of dark days for crude oil prices. The earnings season was just starting to wrap up as the OPEC agreements failed and operators had finished giving their initial guidance out. But after that, once the prices dipped to the low 20s, we saw further cuts in CapEx, and those CapEx cuts continued yesterday with Exxon also further cutting their CapEx. So we're seeing CapEx cuts across the board, and that's going to be what's driving the declines in production in the United States. We are hearing that OPEC Plus wanted the U.S. to actually be a part of these cuts, but we've also heard from the U.S. Energy Secretary that that is not something that we are willing to do as a nation, and we're only going to let the market play its role in declining our production naturally, rather than agreeing to cuts. So moving on to the next slide here. The demand side has really turned negative. We do not have a lot of room to put the refined products from refineries, and that's indicated in the refining economics. A lot of crack spreads have turned negative. Refineries have cut their utilization rates to about 75%, and further cuts are on the way. And that's due to the fact that demand has taken such a large hit due to the COVID-19 virus keeping everybody home. If we move on to the next slide, you'll see that the the demand drop expected in Q2 will mean that we are more than 14 million barrels a day oversupplied at this point in time. So the reason why the markets are not impressed with a 10 million barrel a day to 12 million barrel a day cut number indicated by OPEC is because that doesn't even cover the current oversupply situation. This is why the cuts were needed to be on the level of 15 to 20 million barrels a day to entice higher prices than where we are today. So once demand recovers, though, we do expect that with the decline in production that we'll see from the United States, based on just economics not working out for operators, you can't generate free cash flow at these price levels. We'll likely see that as demand recovers towards the end of the year and supply continues to fall, and OPEC takes some longer-term supply volumes off the table, hopefully, we will actually end up going back to equilibrium, which means that in Q4 and into Q1 of next year is when we expect prices to start to climb their way back up to levels at which shale makes sense. Moving on to the next slide. Shut-ins are definitely something that we are expecting. So shut-ins are going to have to be necessary because already we're hearing that in some areas the operational storage capacity is filled up. We're about 4 to 6 weeks away from filling up all storage that we know of. And it's not easy to build more storage. We've seen the cost of storage go up over the last couple of months, and floating storage has also started to become something people are utilizing, but that is definitely more expensive storage and limited. So potential shut-ins will take place. The variable costs are going to play a large role in that. We expect that the higher cost, older wells producing lower oil volumes are going to be the ones that are shut in first. But those volumes are also not likely to come back the same way as we shut them in. So we could see that the older vertical wells that get shut in may never get put back on production again, just due to the fact that it's not going to be able to have the same reservoir pressure and viability at these certain prices as we have today. Moving on to the next slide. If we look at the price sensitivity of U.S. crude, if we sort of decline at a natural rate throughout 2021, we could see us bottoming out at about 9.2 million barrels, which is a full almost 3.5 million barrel fall in production volumes in the United States. And that is definitely necessary for us to be able to get back to an equilibrium situation in the global supply market out there today. So if we go on to the next slide, we'll see how this breaks out by different parts of the country. So you can see on the left-hand side, Permian is definitely the largest source of crude oil production in the United States at almost 5 million barrels, 4.7 million barrels a day prior to this price drop. It's also going to be the one of the hardest hits because a lot of new wells that have recently started producing added to this growing production levels. And as we know, shale wells decline most in their first 2 years of production. So a lot of Permian wells and the Permian base production has a lot higher decline rate than the rest of the country. That's why the Permian's drop is so marked, whereas some older basins that have a lot larger base level of production will definitely see some declines, but it won't be as marked as what the Permian experiences. As prices recover and we go back up to sort of the $50 to $55 mark, production will come back, and we do believe that by middle of 2025, production will surpass the levels that we were at prior to this price crash, and and head north of 14 million barrels a day on the path that it was on prior to the current unprecedented situation. Moving on to the next slide. This also highly impacts gas, as we talked about in our takeaways. Gas break-evens are very sensitive to crude oil prices. So as crude oil prices drop from 55 to the $20 per mark level that we're at, the associated gas price starts to become important. So on the left-hand side, you can see that at $55 per barrel WTI prices, we would have seen a lot of areas in the Permian and the Eagle Ford and other areas across the country that are oil-directed economic plays. We're going to be producing a lot of associated gas volumes with very little regard to the natural gas prices. Now, as prices drop to 35 and below, we've seen that those natural gas prices start to become important in the actual economics for these producers. And if we see a decline in associated gas production, that means that we will have to signal in the future that we buy gas directed drilling to meet the demand that's going to come for natural gas production. If we go on to the next slide, and slide number 10, we'll see that crude oil prices at $25 a barrel mean that we're going to have a market decline in production of associated natural gas. And that means that if we go over to the next slide, we're likely to see that one slide. Yep, there we go. The demand is still going to be increasing for natural gas, although even with the potential impact of COVID-19 on demand, come the winter time, once this is passed and winter weather-related demand starts to kick in, we will see that we are going to be short natural gas in the US market, and we will need a price signal to make that happen. In the meanwhile, in this time between now and October, if we go on to the next slide, you'll see that we are likely to fill up our inventory levels to above where we've seen it, and close to what we understand is working capacity that's never been reached before. That means that we could definitely see some lower natural gas prices in the interim for the shoulder season, and we expect that there could actually be some shut-ins on the natural gas side as well. However, moving on to slide number 13, our expectation is that because of this decline in production, a sharp increase in natural gas prices in 2021 is going to be necessary, and it will only add some of the losses back. It'll actually take about 3 years to return natural gas production to the 2019 peak production levels. Even if we have a strong price signal and crude oil prices recover to levels that are that allow for us to generate free cash flow mid 2021. Next slide. The operators have definitely slashed their capex plans in relation. A total of $21 billion in capex was taken off the table from the operators that are shown here. That's about a 33% reduction from the initial plans that they had, which were already lower than 2019 levels. So operators are definitely cutting capex because right now cash flow is king, free cash flow generation is king, and at the prices that we see today, very few, if any, operators can actually generate free cash flow to fund their operations and continue to drill and still return some value to shareholders. So if we go on to the next slide, the one thing that we've seen along with this is the impact that it's already had on rig counts. Rig and crew cut counts were down 160 and 60 respectively. we expect another 160 or so rigs to be cut over the next month to month and a half, further putting a dent in service company utilization and activity. Moving on to the next slide, you'll see that there are some operators that are better suited to weather this challenge, and those are the guys that are actually hedged. So operators that have a significant part of their volume hedged at prices where they can generate free cash flow are going to be the ones that do well throughout this downturn. The operators that have chosen to be sort of privy to the movements in prices in the market, those towards the left-hand side of the x-axis are the ones that are most at risk, and will likely see their activity decline more, and they could be driven to bankruptcy levels in terms of free cash flow generation and not being able to service their debt. So the real issue that a lot of these operators that are very, very leveraged, have a lot of debt on their books, and sub core acreage positions and no hedges are going to be the ones that we see succumb to bankruptcy over this period in time, and we do expect those to speed up. We've already seen one last week with Whiting filing bankruptcy, and we do fully expect more companies to follow suit as this wears on into Q3. Next slide. The hedges do fall off a cliff in 2021, so no company can really weather this storm more than the remainder of this year. If prices do not recover by Q4 and Q1 of next year, we will likely see even more pressure on operator financials. And next slide.
Philip, do you want to hop in here, Philip, and give us a quick update or overview of some of the products that might be useful, and then we'll make sure we get the lawyers on as well.
Yeah, definitely. This isn't going to take too long. So, really determining actual insolvency or bankruptcy requires combining a lot of disparate data really into one place, and even having to be able to predict financial markets. And in reality, what most people really want to understand is the risk of a bankruptcy or a shut-in of a property, and really how that will affect them. So just today, Shell announced standing down their frac crews in Delaware. How does that affect you, right? What does it mean for future revenues on checks? Did you overpay? Should you sell? What is your asset worth, right? These are all the questions that rack people's minds every single day in this market. So we just wanted to quickly touch base on the out-of-the-box solutions that all of you have available through various subscriptions, and then some of the new ones you might not be aware of. So the three ways we determine risk, really the first one is, looking at asset valuation and basin risk. The reality is that many people are still buying today, and you really do need to ensure that your underwriting and investment thesis is sound. The second one is operator comparison and benchmarking. It's just sometimes really time consuming, and it's just hard to do in one place. And so we have tools for that as well. And the third is professional reporting and analysis. And again, we understand that for a lot of people, they're not even sure where to start on an investment thesis or their portfolio analysis of risk. And so we do have teams that, stand by to kind of help with that. Next slide. So really, the first one we were talking about on underwriting. So not everybody knows we acquired a company called Q Engineering. And, you might just be starting to put together an investment thesis or portfolio analysis and, want to show why you want to enter a basin or a deal. And really what Q allows you to do is to start analyzing everything from basin economics through integrating VDR data with Enverus data to underwrite. And what you really have to realize is that a company may have hedges to drill, but generally the mineral owner will not benefit from those because the hedges are for them, not for you. So underwriting is not only about the asset itself and what it's worth to the operator, it's also what is it worth to you. So it's fully collaborative for teams that are working from home. And then we also have an on-demand webinar for anyone who's actually interested in that that we can send out later. Next slide. The second one is looking at operator comparison and benchmarking. So we have market research and what we have called operator intel, which really is just allowing you to pull any information you can imagine on a company. So op, non-op acreage, what are their drill times, what is the asset value, what are the PUDs that are left to drill, what benches are left to drill, what is even economic right now on a company level. And that's really a one-click solution that a lot of people enjoy. And then the other one is capitalized. So, there's been a lot of talks about RBLs for these operators and redeterminations, and how does that really affect these companies, especially if there's margin calls on it. And so it's a database that basically just combines all of the debt and equity instruments of these companies to really help you to understand, what is outstanding and what is the risk of those companies. Again, it's allowing people who actually want to put together their own thesis all the little bits of information that you need to put it together. Last slide. And really the last slide is just talking about professional reporting and analysis. So RS Energy and Enverus combined earlier this year. And so as a part of that, there's an RS Intelligence Suite, which is really just a ton of great information and support from their analysts, on everything from hedging through daily reports and webinars, NAV models, all inside of a single database. And so that is also something new that is a part of the Enverus suite as well. And then again, we always have professional services. We have a full team of engineers, geologists, and finance people that, have done hundreds and hundreds of asset valuations. If you're just not even really sure where to start. So we kind of cover, the gambit from everything from needing to underwrite all the way through, doing the work for you if you need it.
Thanks, Philip. I appreciate that. We'll go ahead and jump in here now into, the topics most closely. So Sarp set the stage here for why there's a lot of risk of bankruptcy. Nicholas will go here and his colleague Brian, and we'll get into a little meat of how to sort of prepare for that situation as a mineral owner. So Nicholas, I'll hand it over to you. Thanks.
Yeah, sure. Thank you. And again, my name is Nicholas Miller. I'm an attorney at Graves Doherty. I'm going to speak a little bit. My common representation is mineral and royalty owners and landowners specifically, and then so I'll kind of talk about some leasing issues, what to look for, what to anticipate, things to be wary of, things that you can protect yourself going forward on a lease basis in the event you have the opportunity to negotiate a new one. And then I'll let Brian speak to sort of the bankruptcy specific process since he's more focused on actually the bankruptcy representation. Well, obviously, given all the information you've just heard, I get calls quite often now from clients concerned that their royalty streams could be disrupted by a bankrupt operator. A lot of people are concerned about the health of the industry and the health of the operations and don't know what that might mean for their royalty income stream on a go-forward basis. Really, the first question I always ask and the first thing to pay attention to as a royalty owner are those check stubs that come every month. If they seem to come slower, if there's a deviation in the amount, and if you don't think you're getting paid based on full production, you can look at those up on Drilling Info or Enverus or on the Railroad Commission's website. Then you need to start being concerned because those would be amounts that wouldn't be available as a post-petition amount. Those would be pre-petition amounts. And what I mean by that is once bankruptcy is filed, any amounts that were due or owed or overdue prior to that petition would need to be proved up with a proof of claim. Those would be pre-petition amounts that were owed to you, rather than once the operator does file for actual bankruptcy, those post-petition amounts are completely up to the bankruptcy court. Typically, a receiver will be appointed, or the court will order the company to continue royalties going on an ongoing basis to be paid in an ordinary course of business. And the reason for that is because these leases are the most valuable assets, generally speaking, that the company may have, and they don't want to risk those leases having been terminated or and those obligations not being met. So usually, I'm not saying 100% of the time, but usually that royalty stream will continue with those post-petition amounts after bankruptcy is filed. Now, the pre-petition amounts, you may need to put together a proof of claim if you are owed money prior to the bankruptcy being filed, and you start to notice that you're not receiving a pay stub, or those amounts don't look accurate. And in order to prepare for that, if you do notice a deviation in your pay, you need to start collecting your division orders and your lease and any other documents that you may have, old check stubs that will show that proof of claim, because we will likely have to file a proof of claim with the court in order to claim those pre-petition amounts. Again, post-petition, you will not need to do anything, but pre-petition, if you are owed amounts prior to the filing of the bankruptcy, you'll need to organize those documents and preferably consult an attorney to help you file a proof of claim within the bankruptcy court prior to the deadline set forth in the notice that you'll receive regarding the bankruptcy. That aside, the good news is that royalty owners and royalty streams are protected by statute. And what's commonly known as the first purchaser statute was passed by the legislature in 1983. It's located in section 9.343 of the Texas Business and Commerce Code. And what that does is it modifies the UCC, or the Universal Commercial Code, with a non-standard provision that provides an interest owner, or mineral owner, royalty owner, a security interest to secure those payment obligations from the first purchaser of production. And that covers both the possession of that production and the sales proceeds related to that production. So you actually have a secured interest in both the funds and the actual oil and gas proceeds. And there's no need to perfect that lien. It's already provided by statute, so it's already a perfected lien. Now, there's a little bit of a caveat to that, because in 2009, there was a case called Sampson v. Simcrude. Simcrude was a Delaware formed entity, and that's where they were going through their bankruptcy. And the bankruptcy court in that case ruled that the Texas statute wasn't specific enough, and it didn't incorporate that secured interest didn't attach to that Delaware company, because the Delaware statute is the one that applied, and they didn't have that non-standard provision allowing for a perfected lien in those sales proceeds. And they said that was an unsecured creditor, and so they kind of got in line with all the other creditors rather than being on the front of the line as the first purchaser statute was intended to do. In response to that, the state of Oklahoma in 2010 passed a law that fixed that problem. It said it didn't matter where your business is cited, and that security interest will be perfected regardless of the location of the debtor company. Texas, to date, still has not passed a similar statute. And it hadn't been an issue, it hadn't really been tested until last year in the First River Energy case. It's called NRA First River Energy. And when that was decided, they looked at this issue again, and that court similarly cited out-of-state debtor, said that the Oklahoma provision, or new statute, did give those Oklahoma creditors or royalty owners a secured interest, and so they were able to get in line and get paid first. Whereas any of the Texas owners, they used that 2009 decision to say, nope, this still doesn't work, and that's because the Texas legislature had yet to change the code. So it's very hopeful that they will do so next session, although obviously not a guarantee, as is with anything with the legislature when the legislature is involved. So that's kind of the one caveat that you might not have that statutory lien to rely on. And that actually leads me into my next point about governing oil and gas leases and what you might look at in your oil and gas lease to see if you already have, or if you don't, and you have the opportunity to release again in the future to add to your lease. One is a specific security interest provision that says this is a secured. My interest in this royalty stream is a secured interest, and then you'd also have to file a financing statement with a memorandum of lease to perfect that lien. And that's just kind of a belt and suspenders approach that gets around this 2009 decision that was later confirmed in the 2019 decision, and gives you a secured interest whether or not that statute applies or not. And I realize that's not a common provision in a lot of oil and gas leases, but it may be something you have in yours. It's just worth looking, and it's worth considering adding to it if you have the opportunity to do so in the future. I know I've gotten some pushback on that provision from operators before, saying that their lenders won't allow them to give a first lien on this production except that's kind of that argument has some problems with it, the faulty argument, because technically the royalty owner is already supposed to be first in line. So it's really just trying to tie down that statute and do what the legislature didn't do. The next thing you can think about in a future oil and gas lease is the ability to terminate for non-payment of royalties. Oftentimes, oil and gas leases will say that interest starts to accrue or the lease is in default if an operator doesn't pay, say 30 days after notice. If you give them notice that they haven't paid, then interest will start to accrue and the lease will be in default. We like to add another provision to that says that you also have the option to terminate for non-payment. And that way, it gives the operator a bigger impetus to make those payments, first of all. And secondly, in a bankruptcy context, the bankruptcy court will be very likely to want to continue those royalties being paid because they wouldn't want a terminated lease asset in the bankruptcy estate. Their job is to protect those assets and try to figure out how to divvy them up best. And that's where I'm going to pass over to my colleague, Brian, and he can talk about kind of what happens when the petition is filed, how do you do your proof of claim, and kind of the process from there and what to expect.
So when a bankruptcy is filed for oil and gas related companies, it's typically going to be under either Chapter 7 or Chapter 11. Chapter 7 would be where they basically shut the doors, they're closing down, a trustee is appointed who will liquidate the assets. With very rare exceptions, the trustee may try to sell it as a going concern, but 99% of the time it's just finding what assets are, selling them, and making distributions to creditors. In those circumstances, one of the things that you will want to pay attention to if you're not received any royalty payments that you're owed would be whether there may be claims against the principals of the debtor for effectively misappropriating or misspending the proceeds from your mineral interest production. Usually, if you're going to take that approach, you want to find a group of similarly situated claimants, simply because to be cost effective, it usually requires having a number of mineral interest owners together with one attorney who would be prosecuting those claims, both through the bankruptcy case, but then also potentially through the state court litigation against those principals. If the Chapter 7 is filed, much like with the Chapter 11, which I'll describe a little bit more in detail in a moment, you should get notice of bankruptcy filing, at least initially a mailing that tells you that a bankruptcy has been filed. Oftentimes, if you have an operator that maybe your interests have been transferred years before, you haven't dealt with that operator in years, you may get notice of their bankruptcy filing simply because they put on their mailing list everybody in the world they can think of they've ever been related with. So don't panic if you get notice of a bankruptcy related to someone who is no longer operating your mineral interest. But the notice will tell you what court it's been filed in, for instance, Delaware, Southern District of New York, Southern District of Texas, and it'll give you the information you need to know how you can follow what's happening in that bankruptcy case. In the Chapter 7 cases, you would certainly want to present a proof of claim. Most of the courts have on their websites a way that you can submit a claim without ever having to have an attorney involved, if you'd like. One thing to keep in mind is you would want to attach a copy of your lease to what you upload to the court with that. And frequently, even if you believe you've been paid in full as of the time that the bankruptcy is filed, it may still make sense to file a proof of claim, putting the dollar value as zero and indicating, essentially, in case I have not been paid everything I'm owed, I'm putting my finger here, bookmarking this potential claim. But it's certainly not something that's required. I generally don't recommend that unless you actually believe you've been shortchanged on some of the payments that you are owed. And as Nicholas said, there's non-bankruptcy ways you can monitor what you get paid and then how accurate that is with the debtor. So the good news is majority of the bankruptcy cases that get filed relating to mineral and gas companies are Chapter 11s. That is what we think of as sort of the classic bankruptcy where, at least in theory, the company is trying to reorganize, which is to say they're going to try to keep everything running as a business. Frequently, that will involve basically selling the company, but still the idea is you file a Chapter 11 so the company can keep operating, keep employees, keep making payments to vendors, trade creditors, try to maximize the value of the estate by keeping it as a going concern. Because of the way the bankruptcy statutes are drafted, the bankrupt debtor has a lot of options typically on where it can file. So, for instance, if your operator is one of 50 affiliates, it could file in any one of the federal districts where any one of its affiliates is located, theoretically speaking. So usually we see these in Southern District of New York, Delaware, and occasionally in Southern District of Texas. Otherwise, they generally will file somewhere close to home for the primary headquarters for the debtor. If you get notice that the bankruptcy has been filed, there should be what are called schedules in the Statement of Financial Affairs that each of the debtors is supposed to present to the bankruptcy court. Those would indicate who the debtors say their creditors are, how much they say they owe those creditors. So you could look at those to determine what the debtor says their obligations to you are. And that gives them a good initial information as to, well, typically what the debtor's prospects for prevailing with a reorganization are. And if the finances look really bad for the debtor, you can pretty much bet that they're going to be heading towards a sale of some sort. A lot of the Chapter 11 plans that we've been seeing in the oil and gas sector have been what are called prepackaged plans. That's basically the one that goes in with a plan concept already in place, and it's usually one where they're just going to be bringing in someone to be new equity. Usually it's a secured lender. And in those situations, that's where you want to be, because that's where they basically say everybody other than equity is going to be keeping whatever claims they have, all of their rights. We'll be out of this bankruptcy case in 3, maybe 6 months. So if you're a mineral interest owner, if you're owed any money, you'd still be able to get that from the what's called reorganized debtor. So you want to look at schedules and Statement of Financial Affairs. You're probably not going to get a response if you try to contact the bankruptcy attorneys for the debtor. If you have communications with the debtor's normal company operatives, you can keep doing those. One thing you'll need to keep in mind is when the bankruptcy is filed, something called the automatic stay comes in place. So, for instance, no one, whether mineral interest owner or otherwise, should threaten to terminate a lease or file litigation against a bankrupt debtor. You can do that in the bankruptcy court. You can file litigation. You can ask the bankruptcy court for permission to terminate lease, that sort of thing. But threatening that opens the door to the bankruptcy court granting injunctive relief against you and potentially penalties. And so you just have to tread very carefully once the bankruptcy is filed. You should still be able to communicate with the debtor itself. You're welcome to try to call debtor's counsel. You'll probably not get a response from them unless you get an attorney involved. Typically speaking, it won't make financial sense to get an attorney involved unless you either have a large enough overdue amount owing to you, or you are able to put together a group of other mineral interest owners who are similarly situated in terms of what your leases provide for and concern about what the operator may be intending to do with your leases. The vast majority of the time, the debtor is going to want to play very nice with the mineral interest owners for the obvious reason that it's just a headache if you have several hundred or 1,000 mineral interest owners. To have all of them raising issues in the bankruptcy court, it's incredibly time-consuming for the debtor. So they usually try to make sure they can get all of those folks paid timely, both the pre-petition amounts and the post-petition amounts, the things from before the bankruptcy and the things during the bankruptcy period. There's other things that can be done to protect your interest when the bankruptcy is filed, and those would be, for instance, the sorts of claims that can be presented in the bankruptcy court. There's more than just a proof of claim. There's reclamation rights that may exist. There's what are called administrative claims that can be presented. Those usually only make sense if you're talking about a sizable amount of money that you would be out otherwise. And that would be the sort of thing that you would probably not really recognize until at least a month into the case when the debtors actually start to indicate what it's going to do with what it owes to mineral interest owners. The good news is that at least with the Texas bankruptcy courts, mineral interest owners usually get the recognition and the rights that I think they come to expect in the state courts when they're in bankruptcy court. If your operator files in Delaware, Southern District of New York, it may be a different ballgame. Those courts tend to have a propensity for having a different view of Texas law, on top of the issue that Nicholas mentioned, where there's actually, if you have an operator, for instance, that's in Delaware, the Texas lien statute may not apply to the proceeds. And the Delaware court could be actually expected, I think, to follow that Simcoe decision. But as long as they're in Texas, you should be pretty good. The out-of-state filing, especially if it's Delaware, for instance, would require folks to have a Delaware counsel. So, for instance, a Texas attorney, even if they were to represent you in Delaware, they'd have to get local counsel from Delaware to be on that as well, which just underscores the importance of if you have a claim that you think needs you to participate in the bankruptcy over in order to protect it, it's sizable enough that it merits that. probably going to want to try to find other similarly situated mineral interest owners so that you can put together a group of folks who can form essentially what we call in bankruptcy an ad hoc committee so that you can share the costs. Otherwise, the costs are very quickly going to overrun any expected return you could get out of that. And with that, I'm going to go ahead and wrap up my little part so that there can be time for questions from everybody. I think I've actually run over just a little bit, so I apologize for that.
No problem at all. I appreciate that. We do have some questions. A reminder, go ahead and key them into the question panel. So one question, which is probably for Nicholas and Brian, is let's see here, does bankruptcy court have the ability to revise lease obligations such as continuous drawing closet obligations, production and paying quantity standard, or creating of security interest in the lease as opposed to statute?
Brian, could you speak to kind of how, yeah, go ahead.
The bankruptcy court cannot, over the objection of parties, redraw contracts, which sounds like that's basically what is being proposed right there. Now, if the parties consent to it, they can do that. And sometimes the Chapter 11 debtor, when it presents what's called its Chapter 11 plan, will do something that would purport to make those kinds of changes. But if anyone says, wait a minute, this is a contract I'm a party to, I don't agree with those changes, the bankruptcy court is absolutely not going to make those changes against their wishes. There may be other results that are not favorable. For instance, the court deciding that what you have is an unsecured claim, and so you have to stand in line with other creditors and may or may not get a distribution based on that for the pre-petition amounts. But in terms of forcing you into what is effectively a new contract, that's something that, for instance, if it were to get appealed, the bankruptcy court would absolutely get overturned on because it simply does not have the capacity or authority to make that sort of a new contract.
And just to add on to that and make sure I understand, Brian, what you're saying, and to add a little bit is, so if an operator does have a CDC obligation coming up, that obligation wouldn't go away because that's based on an existing contract, and to change that would be to modify that existing deal. Is that kind of consistent with what you were saying, Brian?
It can, with the caveat that it can breach the contract and basically say, hey, we're walking away from the contract and now the counterparty has a claim against us, but that's it. We're not going to perform anymore. But in terms of redrawing the contract, picking and choosing what they will perform, the bankruptcy court doesn't allow that. Right. They've either got to perform it all or walk away from it. They don't get a choice. Is basically how that works.
Right.
Somebody had a question here about the treatment of overrides in bankruptcy. Are they different from the treatment of mineral rights and royalty rights? Maybe you guys, I don't know if you have any color on that.
So an override would really just be a burden on the leasehold interest, and would be treated the same. I haven't actually faced that specific question, but should be treated the same as the royalty stream. It's really an interest in the royalty stream, which is a real property interest as well.
That is correct. And the underpinning idea there is that the property rights in bankruptcy are defined by state law. So you start by looking at what state law says happens in particular situations, and 95% of the time that's what happens in bankruptcy, with the exception of when specific bankruptcy statutes allow for the debtor to choose different things. That would not be one of those ones. So the override should be treated the same in the bankruptcy as it would outside.
This is an interesting question, is the opposite. What if the mineral owner themselves needs to file bankruptcy for any number of reasons? Any suggestions on what they need to do ahead of filing bankruptcy to protect their rights or interests?
Well, so one thing to keep in mind is that if the owner of mineral interest files bankruptcy, that the mineral interests will be part of the bankruptcy estate. And if they're part of the homestead property, the mineral interest owner may, so for instance, if you own 10 acres of real property, you got your home on it, and you just happen to have oil and gas lease, you may be able to get away with exempting that. I don't think you will, typically speaking. So let's just assume you don't have any sort of a homestead exemption associated with the property your mineral interest is with. That mineral interest becomes property of the bankruptcy estate. If you file Chapter 7, for instance, the Chapter 7 trustee would typically get a chance to market and sell that mineral interest. So
that'd be an asset just like any other real property asset.
Yeah, that's correct. So one of the things to keep in mind is filing in bankruptcy, even if you somehow manage to keep that mineral interest with you on the far side of bankruptcy, you're going to at least draw scrutiny from a trustee who will investigate whether or not he can sell that. And if he decides he can sell that, there's usually not much you can do. Usually, if it has any meaningful value, the trustee will at least try to sell it. The caveat there is there's something called Chapter 13 bankruptcy. It's the idea is a can pay, must pay. So if you have above certain income, you may have to file a Chapter 13 bankruptcy, which requires you to pay what's called your disposable income. That's calculated based on some statutory guidelines over 3 to 5 years. If you do that, you'd be able to keep that asset. But the typical Chapter 7 bankruptcy is one where the trustee would almost certainly look to sell any mineral interests the debtor owns.
I think this might have been answered already, but I'm going to go ahead and ask it just in case it's a little different. Can the mineral owner terminate the lease because of non-payment if payment's tied up in bankruptcy, or can they change the lease at all? I think you might have answered that, but maybe you can just touch on that one again.
I believe that they would have to apply for termination through the bankruptcy court. Is that right, Brian?
Yeah, so if it's a pre-petition amount that is owed and they want to turn it down, they absolutely would have to get relief from the bankruptcy court beforehand. If it's a post-petition amount, what almost every bankruptcy attorney would tell you is because of the potential downside of the bankruptcy court using the automatic stay against you, should you take any misstep, the prudent thing to do is to get relief from the bankruptcy court before going forward with termination. The caveat I would put on there is it's conceivable the debtor would say, yeah, absolutely, go ahead and terminate. We'll do what's called abandoning that property interest anyway, so you can terminate. We don't care. They're obviously only going to do that if they don't think that the lease is of any value to them, so it does not happen very often, but it's conceivable.
In terms of one of the things you suggested was to maybe get together with some other owners to collectively make claims to reduce sort of legal cost or share it among them. I think someone was asking how you might find out. I think I've seen from prior bankruptcies that oftentimes it's sort of public record. It'll send out the list of all the royalty owners. Maybe you can give some color on that.
So if you look at those schedules and statement of financial affairs that I referred to earlier, you should be able to discern from those who all of the mineral interest owners are, because the debtor, at least theoretically, should list them and identify them as mineral interest owners. But also, there's a part of the Department of Justice called the United States Trustee, Office of the United States Trustee. And they are kind of watchdogs for bankruptcy. They're what I would call neutrals, except for they have the right to appear before the court on any issue. And they typically try to make sure that creditors are given a fair opportunity to be heard, and that the debtor follows through on jumping through each of the hoops it's supposed to. If you have an interest in trying to get a group of mineral interest owners together, I would start with the schedules and statement of financial affairs, but then I would call the Office of United States Trustee, and I would express interest in a committee of mineral interest owners, because United States Trustee quite likely at that point in time would then go through the process internally of trying to figure out if there will be enough mineral interest owners interested to form a committee that could potentially then have counsel who would be paid out of the bankruptcy estate, which is not at all unheard of. It's not all that common, but it's not at all unheard of. So that would be the ideal circumstance. You get representation through a committee that you don't even have to pay for. So that would be the place to start in my book. And if the U.S. trustee is not able to put together a committee from the schedules and so forth, you should still be able to figure out who the potential other claimants are. And then if you're paying attention when it's filed in the bankruptcy case, you may see a group of claimants actually start doing things, at which point you could reach out to their counsel and say, hey, I'm a mineral interest owner too. I'm actually interested in sort of having you put me into your group of folks so that I can be represented alongside them.
I'll add to that just one little thing that's outside of the bankruptcy court context. You can tell from the appraisal district records filed in counties as to who has interest in which wells and things like that. And to give you guys at Enverus Drilling Info a little plug, the mineral appraisal through your site, you can look at individual wells. So you look at the wells in which you have an interest, and you can see all the other parties that do have an interest in that well as well. So that gives you a pretty good list as to at least some potential people to group together with.
I appreciate the commercial there for the Enverus Texas Mineral Appraisals database. We had a bunch of questions about different interest types, but I think I'll ask it a different way. Is there any precedence within them? Like, do royalties get paid before working interest in a liquidation, or are they all treated the same? Maybe you can give some color on that.
Brian, I'm not sure I know the answer to that. It's my understanding through the first purchaser statute that the royalty owner has the prime position, but I'm not sure if that varies as between types of interest like that.
I think it would probably vary more on whether your bankruptcy case is in Texas or Delaware, for instance, because the Texas courts are very fond of the mineral interest owners and the protections the statute provide them. So the bankruptcy code, the federal statutory scheme that governs bankruptcy, creates a priority waterfall for who gets paid in what order. And it's not at all, well, in very minor ways, it would be different from the priority scheme that under state law. So if you're a secured creditor, you're going to get paid out of your collateral. If you're owed anything after that, you join the pool of unsecured creditors. So the critical question for anyone, whether they're mineral interest owner or otherwise, is going to be, am I secured against what, and what's the value of my collateral? So if my collateral is worth more than I'm owed, I should be able to get paid in full without having to join the unsecured class. If, for instance, let's say I've got a Delaware court that doesn't view me as being secured on the proceeds, but there was production after the bankruptcy was filed and I didn't get paid for that, I may still be what's called a priority claim, because essentially the idea behind that is the expenses of funding the debtor after bankruptcy should be ahead of the pre-bankruptcy claimants. So there's that secured creditors at the top. There's kind of a middle level of these what are called priority administrative claimants that may get paid before you get down to the unsecureds. So there's various places they can slot in that all depend on mostly the statute, some extent the court. But typically speaking, most mineral interest owners are getting treated as secured creditors in Chapter 11 cases. That may be just for simplicity from the debtors, and because they recognize that having big fights over mineral interest ownership is going to be very problematic. But the practical upshot of that is for most mineral interest holders, you can hope for and reasonably expect good treatment in a Chapter 11 bankruptcy. All bets are off in a Chapter 7. That's one where you want to monitor much more closely, and I would much more strongly recommend getting a group of similarly situated folks together in those circumstances if you're looking to recover monies owed.
Maybe we could skip forward one slide here. Just I want to make sure everyone sees some contact information. We'll do probably try to squeeze in one last question here, but everyone here has agreed they're happy for you guys to reach out to them, follow up. I'm not sure, there's so many good questions, I'm not sure which one to pick, but I'll pick one on a topic we haven't talked about, which is, do you have time to touch on how this would work for a working interest owner without a JOA in place?
Working interest owner without a JOA in place would really just be kind of similar to an unleased co-tenant. And so that would be, again, a real property interest owner, but they wouldn't be owed anything until the well's paid out. So I'm not sure about the answer to that. I was just trying to lay it out for Brian a little bit, just in case he wasn't sure what that was.
Okay.
Do you know that? Do you know, Brian?
I've not seen that situation.
Okay.
So I'm not very certain what would be done with that.
Okay.
We do have a bunch more questions, but we are at time. We'll try to answer some of them here. We'll email you. We've got the list that are written in here. We'll follow up. But I appreciate everyone taking time. I appreciate all my colleagues and Nicholas and Brian for joining in. I think it was a great topic. As we said here, everyone's contact information is here. We're all open to chatting. Great resources. Also, want to wish everyone a happy Easter and a happy Passover. So thank you all for joining us. and we'll get this recording out for you. I think early next week, you should get an email with the recording so you can track back. I know there were some questions related to some of the slides that SARP had, and those will be in there, so you can look at them more closely through the recording as well. So thank you, everyone. Have a great weekend, and we'll talk soon.